California's housing market is starting to crack, and some suburbs are showing red flags right now. Today, we're breaking down the top 10 California suburbs most at risk of a housing downturn in 2025. If you live in one of these areas, pay attention. Hit subscribe so you stay ahead of the market. Santa Clarita. Santa Clarita once felt like a safe suburban bubble. Good schools, commuters to LA, and family-sized homes. But 2025 data show it cooling. Local Home Value Index shows Santa Clarita home values slipping year over year, about approximately 1.8% decline in the most recent data, and zip-level pages show some neighborhoods down similarly. Small declines, but important because Santa Clarita had been priced on stability. Why this matters? A small, persistent decline in a commuter suburb can cascade. Sellers who bought near the market peak may delay listing or expect peak prices. When inventory rises and buyers push for discounts, homes sit longer and price cuts spread through comps. Local reports also point to longer days on market and a move from a pure seller's market toward balance. That's the kind of environment where price discovery can drop quickly if sentiment shifts. Other risks specific to Santa Clarita. It's tied economically to the greater LA area's job market and interest rate sensitivity. If mortgage rates stay elevated or there's a regional employment shock, commuting families can't pay more. Demand softens while supply creeps up. That combination historically magnifies local corrections. Also watch for appraisal gaps. If buyers stop paying over ask, appraisals can come in lower, scaring sellers into price reductions. Bottom line, Santa Clarita isn't collapsing yet, but data show flattening or mild declines, more inventory, and longer market times. For hip pocket protection, don't assume peak-era comps will hold. If you own, get conservative refinance or contingency plans. If you buy, price in at least a modest downside scenario. Calabasas. Calabasas is a luxury outpost. Pricey homes, celebrity buyers, and limited inventory. Luxury markets have been the canary for corrections because they're most sensitive to wealth, volatility, and discretionary buying. Calabasas shows softening in price per square foot metrics even while median price levels can appear stable. That split signals fewer sales and quieter demand beneath the headline numbers. Why luxury cracks early? Wealthy buyers respond to wealth shocks and financial uncertainty faster than the mass market. Recent national coverage highlights slowdowns in the luxury segment and rising luxury inventory. When supply creeps up and buyers hesitate, sellers may sharply cut prices to transact. Calabasas, with its high concentration of pricey homes, can see outsized percent swings when a handful of expensive listings stall. Local signs to watch: fewer transactions, falling sales counts, longer days on market, and price per square foot declines. These are already flagged at neighborhood broker reports. Also notice shifts in luxury buyer behavior: more contingencies, fewer all-cash offers, and longer negotiation cycles. Those micro shifts blow up into bigger competitive price drops if multiple high-end sellers compete in the same window. Bottom line, Calabasas is not guaranteed to crash, but its luxury orientation makes it an early warning market. When sentiment flips, percent declines can be large quickly. Sellers should be realistic about comps. Buyers may find negotiating room, but only if they price models conservatively. Santa Rosa. Santa Rosa felt pressure long before 2025 because of wildfire risk, insurance headaches, and affordability limits. Santa Rosa's average home value has fallen over the last year, reflecting both climate risk premiums and shifting buyer preferences away from higher risk zones. Wildfires change the calculus. Higher insurance costs, tougher lending in wildfire-prone ZIPS, and reluctant buyers all reduce demand. UCLA and other regional studies show wildfire-affected areas often underperform peers for years after major events. Santa Rosa is in that vulnerable category because of recent fire history and proximity to high-risk wildland-urban interface zones. When you combine climate/insurance headwinds with broader 2025 inventory rises and a slower luxury/second home market, Santa Rosa becomes a market that may experience sharper local corrections than statewide averages. Local sales volumes are lower and time on market increases. Early signs of buyer caution. If financing gets tighter for properties in higher risk tracts, or insurers withdraw coverage or raise prices, that can trigger price declines faster than in low-risk areas. Bottom line, Santa Rosa's risk mix makes it a candidate for local downside in 2025, even if broader California avoids a massive crash. Investors and owners should check insurance renewals, restrict assumptions about future appreciation, and consider downside scenarios. Burbank. Burbank's proximity to Hollywood studios and high-end renters historically insulated it, but the studio/entertainment sector's cyclical nature and recent price normalization make Burbank one to watch. Local market trackers show that median asking and sale prices have stalled in some months and that appreciation has cooled compared with the hyper-growth years. Key local stressors. Burbank's inventory can rise quickly when owners aim to capture peak prices, for example, when stock or bonuses run hot in LA. If entertainment industry hiring slows, or if production budgets tighten, higher rent households pull back. Rental demand softens, investors reduce activity, and single-family buyers get squeezed. Those levers can flip pricing quickly because much of the local market is tied to employment in a few sectors. Recent neighborhood reports show more price cuts and smaller year-over-year gains than the market's peak. Watch the luxury segment and days on market trends. Luxury and upper-tier markets in Southern California have shown early signs of cracking, slower sales, rising inventory, and because Burbank overlaps that bracket, it's vulnerable to faster corrections. If mortgage cost sensitivity increases among buyers, or if investors start pulling back, you can see price declines accelerate locally. Burbank's fundamentals aren't broken, but the market has less margin for error than in low-cost regions. Buyers should demand strong contingencies, and owners should budget for a scenario where comps soften 5% plus if regional demand weakens. Chula Vista. Chula Vista is often cast as a more affordable alternative to coastal San Diego, and that's both a strength and a risk. Values are going down modestly year over year, but other market updates show recent months of rising days on market and softening sales pace. Indicators to watch. Risk vectors here include affordability ceilings and local job dynamics. If mortgage rates keep buyers' monthly payment pressure high, families priced to the margin get priced out. That reduces effective demand quickly. Also, Chula Vista has a significant single-family inventory purchased by owner-occupiers who may be reluctant to sell into a weaker market. When some do list simultaneously, supply jumps and downward pressure accelerates. Recent agent updates for January 2025 still showed some year-over-year appreciation in certain months, but that momentum can reverse quickly if buyer appetite cools. Another watch. Spillover from San Diego's market. If coastal demand cools, and it has in some months, the inland suburbs that rely on spillover buyers, Chula Vista included, feel the chill later and sometimes more intensely because buyers can wait or choose to stay put. That lag can produce sharper local corrections. Chula Vista's fundamentals aren't collapsing, but worrying signs, slower sales in agent reports, and affordability stress mean it's a candidate for a steeper local correction if regional demand weakens. Berkeley. Berkeley is in a unique spot. East Bay housing had outsized pandemic gains, but the 2025 data show notable year-over-year declines in home values alongside policy changes like easing single-family zoning that complicate the supply-demand picture. Two forces at work: tech sector employment swings and local policy shifts. The Bay Area's tech employment trend influenced demand. Pockets of renewed tech hiring have helped San Francisco selectively, but East Bay suburbs like Berkeley can be hit hard when remote work persists and high-earning renters downsize or relocate. Plus, local policy changes aimed at densification change investor expectations on future single-family scarcity. Some buyers may delay buying until new projects are built, and that can depress prices temporarily. Local indicators: longer days on market in several Berkeley neighborhoods. That indicates buyer hesitation and a repricing of historically high comps. For homeowners, this means you should not assume instant recovery to 2021 to 2022 peaks. For investors, be skeptical of flip margins without stress testing for another 5 to 10% downside in key neighborhoods. Berkeley's mix of policy change, coastal pricing, and Bay Area labor market sensitivity makes it vulnerable to sharper corrections than more diversified suburban markets. San Bernardino. San Bernardino has the ingredients of a vulnerable market: lower absolute home values, making percent swings possible, higher foreclosure listing counts in the county, and measurable year-over-year softening in home values. The area's average home value down modestly year-over-year, not dramatic, but a trend that matters because affordability in these inland metros depends heavily on steady demand and refinancing-friendly rates. Why inland metros are fragile. When the Bay Area and coastal markets wobble, some buyer spillover stops flowing inward. Also, inland areas can have higher exposure to jobs in sectors more sensitive to economic cycles. County-level foreclosure listings are higher than coastal peers, and a spike in distressed listings can rapidly add fuel to downward price pressure. San Bernardino County's foreclosure counts in bank-owned inventory warrant watching. Local affordability is a double-edged sword. It attracts buyers in good times, but in a rising rate or recession scenario, marginal buyers disappear first. If more sellers need to transact, life events, job changes, or investors pulling out, the available supply rises and discounts follow. For owners, keep reserve cash and plan for longer time on market. For buyers, insist on strong inspections and factor in a conservative resale scenario. San Bernardino's lower base prices don't make it immune. In fact, they can enable large percentage declines when sentiment sours. This is a market to watch closely in 2025. Vallejo. Vallejo has seen notable year-over-year declines in values in recent data, partly because buyers have alternatives in nearby Contra Costa and Marin counties, and because some Vallejo neighborhoods suffer from higher crime perception or lower demand at the margin. These declines are meaningful for a local market used to steady demand. What makes Vallejo vulnerable is the relative ease of substitution. Buyers who might have picked Vallejo can pivot to neighboring towns if mortgage pain or market uncertainty increases. When buyers have options, price elasticity is higher, meaning a small demand decline equals a bigger local price correction. Additionally, Vallejo's port and military-linked employment patterns can introduce concentrated risks if contracts or base-related hiring softens. Local indicators include falling ZHVI in multiple ZEED IPS and pressure on lower-tier neighborhoods. That can generate cascading effects. Lower-tier discounts pull down nearby comps, reducing seller confidence and prompting price cuts. For investors, Vallejo requires tighter underwriting. For homeowners, conservative planning is prudent. Bottom line, Vallejo's year-over-year declines and substitutability with nearby markets make it vulnerable to outsized local corrections if higher mortgage costs persist or if regional employment cools. Keep a close eye on monthly ZHVI and foreclosure listing activity. Stockton. Stockton's recent history includes boom-bust patterns and higher sensitivity to regional job cycles. Stockton home values have declined over the past year, mid-single-digit falls, and local market commentary shows mixed signals on sales volumes and inventory. That combination raises the risk of a sharper correction if broader conditions worsen. Why Stockton? It's often an early indicator for inland California corrections because it attracted move-up buyers and investors during the rapid price run-up years. When mortgage costs rise or investor demand cools, Stockton sees the effects sooner. Layoffs, weaker rental demand, and investors deciding to cash out can increase supply quickly. That can drive price declines beyond the state average. Local warning signs: falling ZHVI, longer time on market, and a higher share of price reductions. Even modest declines are meaningful for households that bought at peak prices and for investors with thin margins. If national forecasts of modest price declines play out, Stockton is likely to be among the harder-hit inland metros. Stockton isn't a guaranteed crash scenario, but it's a higher-risk candidate because of its historical volatility, investor exposure, and the early signs of year-over-year softening. Buyers and owners should model downside scenarios and keep contingency funds. Antioch. Antioch show a mid-single-digit year-over-year decline in home values in several zip codes, and falling median sale prices in some months. Antioch was an affordable outpost for Bay Area buyers during the run-up, but that also makes it exposed when buyers cut back on commutes or remote work home purchases wane. Why that's risky? Antioch's buyer pool includes commuters and investors, two groups who can withdraw quickly if rates or job prospects worsen. If commuters delay moving because of higher monthly mortgage costs, demand drops and inventory can rise. Investors with thinner margins might list, increasing supply and pushing prices down faster than in tighter markets. Local watch items, price reductions, more contingent offers, and longer time on market in Antioch. If the broader forecast of modest list price declines in 2025 materializes, Antioch's exposure makes it a candidate for deeper localized weakness. Buyers should stress test affordability. Owners should avoid leveraging at tight margins. Bottom line, Antioch's affordability advantage can flip into a vulnerability when marginal buyers vanish. The present year-over-year drops in sales softness make it a suburb to monitor closely in 2025. Okay, that's the list. Santa Clarita, Burbank, Santa Rosa, Calabasas, Berkeley, Chula Vista, San Bernardino, Stockton, Vallejo, and Antioch. If you're in one of these areas, breathe, but don't ignore the signs. Check neighborhood, housing data, insurance renewals, foreclosure listings, and local days on market. My sources are linked in the description so you can dig deeper. If you want a follow-up video where I map the exact zip codes to watch or break these down by most at risk versus watch list, comment below which one you live in. Hit like if this helped, subscribe for more market deep dives, and share this with someone shopping for a home in California.